Ladies and gentlemen, right now, at this very moment, the Nasdaq Composite is hemorrhaging billions of dollars in market value every single hour. And what's happening today isn't just another routine correction or a technical blip on the radar. This is Wall Street's darkest Tuesday in recent memory. A day when the technological titans that have dominated global wealth creation for over a decade are suddenly being thrown into a violent, unforgiving downward spiral that's wiping out fortunes faster than most investors can even comprehend what's hitting them. The numbers scrolling across your screen right now represent something far more sinister than a simple market dip. They represent the potential unraveling of the greatest wealth concentration mechanism in modern financial history. And if you have any exposure to tech stocks, index funds, or retirement accounts tied to the Nasdaq, what unfolds in the next few hours could fundamentally alter your financial future. So what makes this particular Tuesday so uniquely catastrophic? Why is this day being whispered about in trading floors and investment banks with the kind of dread usually reserved for flashback memories of Black Monday or the 2008 financial crisis? The answer lies in a perfect convergence of factors that have been building beneath the surface like tectonic pressure, and today, that pressure finally found its release point. This isn't just about one earnings report disappointing Wall Street or one Federal Reserve official making an offhand comment. This is about the systematic dismantling of assumptions that have underpinned trillions of dollars in investment decisions, assumptions that are now being violently questioned all at once. The tech sector, which has been treated as an invincible fortress of innovation and growth, is suddenly looking vulnerable, overextended, and terrifyingly fragile. And the institutional money that poured into these stocks with unshakable confidence is now rushing toward the exits with equal conviction. The Nasdaq has always been more volatile than broader market indices, but what's happening today exceeds normal volatility patterns by orders of magnitude. Tech stocks are collapsing at a rate that's outpacing other sectors by a ratio that should alarm anyone paying attention. While the Dow Jones might be down 1%, the Nasdaq is shedding 3 or 4% in the same time frame, and certain individual tech names are experiencing drawdowns that look more like company-specific catastrophes than sector-wide adjustments. This disparity reveals something crucial about how modern markets actually function versus how most retail investors believe they function. Tech stocks have become so interconnected, so interdependent, and so concentrated in major index funds and institutional portfolios that when they start falling, the gravitational pull becomes self-reinforcing. Money doesn't just leave these stocks randomly. It leaves in coordinated waves that amplify each other, creating a cascade effect that turns a manageable decline into a full-blown rout. Recent market data has been flashing warning signals that most investors either ignored or didn't know how to interpret correctly. The euphoria around artificial intelligence stocks that dominated financial headlines for months has started to curdle into something much darker. Investors who were willing to pay any price for exposure to the AI revolution are suddenly asking uncomfortable questions about actual revenue, profitability timelines, and return on investment. The narrative that justified extreme valuations is being stress-tested in real time, and it's not holding up under scrutiny. Companies that were trading at price-to-sales ratios that would have been considered insane just a few years ago are now being repriced with brutal efficiency. The market is essentially saying that it no longer believes the future cash flows justify the present valuations. And when the market makes that determination collectively, the adjustment happens with shocking speed and violence. Valuation fatigue has set in across the entire technology sector. For months, analysts and portfolio managers have been publishing research notes expressing concern about stretched multiples, unsustainable growth expectations, and the disconnect between stock prices and fundamental business performance. These concerns were largely dismissed during the upward momentum phase because rising prices create their own justification in the minds of momentum traders. But once prices start falling, all those ignored valuation concerns suddenly become the dominant narrative. Investors who were perfectly comfortable owning stocks at 60 times earnings last week are now panicking about the same stocks at 50 times earnings this week. Not because anything fundamental changed overnight, but because the collective psychology shifted from greed to fear, from confidence to doubt, from buying the dip to selling the rip. Rising uncertainty is perhaps the most toxic ingredient in this poisonous cocktail. Markets can handle bad news if it's definitive and quantifiable. What markets cannot handle is ambiguity, especially when that ambiguity surrounds massive structural questions about interest rates, regulatory environments, geopolitical tensions, and technological disruption. Right now, institutional investors are looking at their tech holdings and realizing they cannot confidently model what these companies will earn, what multiple investors will pay for those earnings, or what the competitive landscape will look like 12 months from now. That level of uncertainty triggers a defensive response. And defense in portfolio management means reducing exposure, raising cash, and selling positions before your competitors sell theirs and drive prices even lower. This uncertainty is triggering systematic institutional selling on a scale that retail investors rarely witness directly. When large funds decide to reduce their technology allocation from, say, 40% to 30% of their portfolio, they're not making that adjustment by selling a few thousand shares here and there. They're liquidating positions worth hundreds of millions or even billions of dollars, and those sell orders don't just disappear into the market without impact. They create pressure, visible pressure, that other algorithms and traders can detect, which then triggers additional selling from different players who don't want to be caught on the wrong side of a major institutional unwind. This is how markets actually operate at the institutional level, far removed from the tidy narratives about long-term investing and fundamental analysis that get promoted to retail investors. The role of algorithms in accelerating today's losses cannot be overstated. Modern markets are dominated by systematic trading strategies, high-frequency trading operations, and quantitative funds that execute based on mathematical models rather than human judgment. When prices break through certain technical levels, when volatility spikes above specific thresholds, when correlation patterns change in particular ways, these algorithms automatically generate sell signals across hundreds or thousands of positions simultaneously. This automated selling creates additional downward pressure, which triggers additional algorithms, which creates more selling pressure, which triggers more algorithms, in a feedback loop that can overwhelm human discretionary buying within minutes. What you're seeing today isn't just investors changing their minds about tech valuations. You're watching an algorithmic chain reaction that feeds on its own momentum and accelerates with each successive wave of programmed selling. Exchange-traded funds, which were supposed to democratize investing and provide easy access to diversified portfolios, are actually amplifying the selling pressure in ways their creators never fully anticipated. When investors redeem shares of Nasdaq tracking ETFs or technology sector ETFs, the fund managers must sell the underlying stocks to raise cash for those redemptions. This forced selling happens regardless of whether the fund manager thinks it's a good time to sell or believes the stocks are fundamentally undervalued. The mechanical nature of ETF redemptions means that fear becomes self-executing. As prices fall, more investors want out, which forces more selling, which drives prices lower, which triggers more redemptions. In another vicious cycle that has no natural break except complete exhaustion of sellers or intervention by buyers with enough capital and conviction to absorb the selling pressure. Stop-loss cascades are activating across the market like a series of financial landmines that were set months ago and are now being triggered in rapid succession. Millions of retail investors and even sophisticated traders use stop-loss orders as a risk management tool, setting predetermined price levels where their positions will automatically be sold to prevent larger losses. The problem is that these stop-loss levels tend to cluster around obvious technical support points, round numbers, and previous low points. When prices fall through these levels, thousands of stop-loss orders execute simultaneously, creating sudden bursts of selling volume that drive prices even lower, which triggers the next layer of stop-loss orders, then the next layer, then the next. What starts as an orderly retreat becomes a panicked stampede, and once a stop-loss cascade begins, it typically doesn't end until prices have fallen far enough to exhaust all the clustered orders and find buyers willing to step in at heavily discounted levels. Liquidity, the lifeblood of any functional market, suddenly evaporates when fear replaces confidence. Under normal conditions, there are always buyers willing to purchase stocks at some price, and the spread between bid and ask prices remains relatively tight. But when panic sets in, potential buyers step back from the market simultaneously, waiting to see where the bottom might be before committing capital. This withdrawal of buy-side liquidity means that sell orders have to accept progressively lower prices to find execution, and the gap between where stocks were trading and where they can actually be sold widens dramatically. This liquidity vacuum is particularly pronounced in tech stocks because so much of the buying over the past year came from momentum traders and algorithmic strategies that disappear instantly when momentum turns negative. The dedicated long-term buyers who provide stability during market stress simply don't have enough capital to absorb all the selling when the momentum crowd reverses direction. Interest rate expectations are silently draining capital from the technology sector through a mechanism most investors don't fully understand. Tech stocks, especially growth-oriented companies with most of their expected cash flows far in the future, are extraordinarily sensitive to changes in discount rates. When interest rates rise or are expected to remain elevated for longer than previously anticipated, the present value of those future cash flows declines mathematically. This isn't about sentiment or psychology, it's pure financial mathematics. A company expected to generate substantial free cash flow 10 years from now is worth significantly less today if you have to discount those cash flows at 5% instead of 2%. The market is currently repricing the entire technology sector based on revised expectations about how long interest rates will remain restrictive, and that repricing is brutal and mechanical. Stocks that were priced for a low-rate environment are being forcibly adjusted to reflect a higher rate reality, and the adjustment process is measured in percentage points of market value destroyed per hour. Capital rotation is accelerating this outflow from technology as institutional portfolios shift allocations toward sectors that perform better in higher rate environments. Banks, energy companies, utilities, and other value-oriented sectors suddenly look more attractive on a relative basis when growth stocks are losing their premium valuation. This rotation isn't driven by fundamental analysis of individual companies. It's driven by macro-level portfolio construction decisions made by large funds that need to rebalance their exposure based on changing market conditions. When billions of dollars rotate out of tech and into other sectors, it doesn't happen gradually over months. It happens in concentrated bursts over days or even hours, and we're witnessing one of those concentrated rotation events right now. The money leaving the Nasdaq isn't disappearing from markets entirely. It's being redeployed elsewhere. But that's cold comfort to anyone holding tech stocks, watching their portfolio values crater in real time. Market psychology has flipped from euphoria to panic with the kind of speed that characterizes major inflection points in market cycles. Just weeks ago, analysts were competing to publish the most bullish forecasts for tech stocks. Investors were confidently buying every dip, and any questioning of valuations was dismissed as outdated thinking from people who didn't understand the transformative power of artificial intelligence and technological innovation. That confidence has evaporated. The same investors who were certain prices could only go higher are now equally certain that they need to reduce exposure immediately before losses get worse. This is the essential nature of market psychology at extremes. It's binary, it's emotional, and it's self-reinforcing. Fear feeds on itself just as powerfully as greed did on the way up. And once fear becomes the dominant emotion, rational analysis takes a back seat to instinctive self-preservation. Historical patterns of Nasdaq sell-offs reveal an uncomfortable truth about how these events typically unfold. They don't start with obvious triggers or clear warnings. They start with subtle shifts in momentum, minor breaks in technical support levels, and gradual increases in volatility that most investors dismiss as normal market noise. Then, seemingly overnight, the selling accelerates, catching the majority of market participants off guard and unprepared. The crashes of 2000, 2008, and even the pandemic drawdown in 2020 all followed similar patterns in their early stages. What looked like a manageable correction in the first few days evolved into something much more severe as the selling fed on itself and psychological confidence collapsed. Today's action has all the hallmarks of those early-stage accelerations, where the market is transitioning from a controlled decline to something potentially more chaotic and destructive. The mechanics of market crashes aren't as mysterious as they seem to outsiders. They follow predictable patterns driven by leverage, forced selling, liquidity constraints, and psychological feedback loops. What makes them feel sudden and unexpected is that most investors don't monitor the subtle warning signs that precede the obvious breakdown. By the time the crash becomes undeniable, it's already well underway, and the opportunity to protect capital is past. Right now, in this moment, the question isn't whether a significant correction is happening. That's already confirmed by the price action. The question is whether this correction will find a floor quickly and stabilize, or whether it will continue cascading lower as each wave of selling triggers the next, exhausting buyers and overwhelming the market's natural shock absorbers until prices reach levels that seem unthinkable based on last week's valuations. What this unfolding storm means for your portfolio depends entirely on your exposure to the Nasdaq and technology stocks. If you're heavily weighted toward tech, either through individual stock holdings or through index funds tracking the Nasdaq or S&P 500 technology sector, you're experiencing real, measurable wealth destruction today. The numbers on your brokerage statement aren't abstract statistics. They represent actual purchasing power that has been eliminated from your net worth in a matter of hours. For those approaching retirement or relying on portfolio distributions for income, this kind of rapid drawdown can have serious consequences that extend far beyond temporary paper losses. The sequence of returns matters enormously in retirement planning, and experiencing a major market decline in the early years of retirement can permanently impair your financial security, even if markets eventually recover. Index fund investors face a particular challenge during events like today because the passive strategy that worked brilliantly during the long bull market becomes a source of forced exposure during the decline. You cannot selectively reduce your technology allocation within an index fund. You're locked into whatever weighting the index dictates, and the Nasdaq indices are heavily concentrated in the largest technology companies. This means your fund automatically has massive exposure to the stocks experiencing the most severe declines today, and there's no mechanism to adjust that exposure without selling the entire fund position. This structural feature of index investing works wonderfully when those concentrated positions are rising, but it creates acute pain when they're falling, and it's a vulnerability that many index investors never fully considered during the comfortable accumulation phase. Your retirement accounts are particularly vulnerable to this kind of market event because of the long-term nature of the investments and the limited ability to make tactical adjustments within retirement plan structures. Most 401k plans offer a limited menu of investment options. And the process of moving money between those options often takes days to execute, which means you cannot respond in real time to rapidly changing market conditions. By the time you recognize the severity of a market decline and initiate a reallocation, prices may have already fallen substantially, locking in significant losses. This is by design, as retirement accounts are structured to discourage market timing and promote long-term holding. But the flip side is that you're essentially strapped into your seat during market turbulence with limited ability to adjust your exposure or protect your capital. The interconnection between different parts of the financial system means that major Nasdaq declines don't remain isolated events. They ripple through the entire economy through multiple channels. Wealth effects cause consumers who feel poorer after watching their portfolio values decline to reduce spending. Companies that rely on access to capital markets find that funding becomes more expensive or unavailable entirely. Employee compensation tied to stock options loses value, affecting morale and retention. Venture capital and private equity valuations adjust downward, making it harder for startups to raise funds. Banks and financial institutions holding significant equity portfolios experience balance sheet stress. The confidence that underpins economic activity erodes gradually and then suddenly, and what started as a stock market problem morphs into a broader economic challenge that affects employment, growth, and stability across multiple sectors. Market timing is notoriously difficult, and the conventional wisdom about staying invested through volatility is based on sound historical evidence. But there's a critical difference between a temporary correction and the early stages of a more severe and prolonged bear market. Distinguishing between these scenarios in real time is incredibly challenging, which is why institutional investors focus obsessively on monitoring multiple indicators simultaneously, looking for patterns that historically preceded major market regime changes. Retail investors rarely have access to the same data, analytical tools, or experience, which puts them at a significant disadvantage during these critical inflection points. The irony is that the investors who need protection most during severe market declines are the least equipped to recognize when protection is necessary or execute the strategies that would provide it. The narrative surrounding artificial intelligence, which drove so much of the recent rally in technology stocks, is now being questioned with the same intensity that it was previously embraced. Investors are asking harder questions about monetization timelines, competitive advantages, regulatory risks, and whether the massive capital expenditures required to build AI infrastructure will actually generate proportional returns. These are legitimate questions that should have been asked months ago, but market euphoria suppressed critical analysis in favor of momentum chasing. Now that momentum has reversed, the critical analysis is flooding back in, and companies that were given the benefit of every doubt are suddenly being viewed through a much harsher lens. This whipsaw in sentiment is characteristic of bubble dynamics, where assets are first bid to unsustainable levels based on narrative-driven speculation, and then repriced violently downward when reality fails to match the narrative's promises. Volatility begets volatility in modern markets due to the proliferation of volatility targeting strategies employed by systematic funds. These strategies automatically reduce equity exposure when volatility rises above certain thresholds and increase exposure when volatility falls. This creates a procyclical dynamic where rising volatility triggers selling, which increases volatility further, which triggers more systematic selling, and yet another feedback loop that amplifies market moves in both directions. Today's elevated volatility is therefore not just a symptom of the underlying market stress. It's an active contributor to the selling pressure, mechanically forcing systematic strategies to reduce exposure regardless of fundamental views on whether stocks are over or undervalued at current prices. The speed at which information travels and trading decisions get executed in modern markets means that corrections happen much faster than they did in previous decades. What might have taken weeks to play out in the 1990s now happens in days or even hours. This compression of time creates intense psychological pressure on investors, who suddenly find themselves sitting on significant losses, with very little time to process what's happening or formulate a rational response. The human brain didn't evolve to make optimal financial decisions under this kind of time pressure and uncertainty, which is why so many investors make emotionally driven mistakes during rapid market declines. They sell at exactly the wrong time, lock in losses that would have been temporary if held, and then miss the initial recovery phase because they're too traumatized to re-enter the market. Institutional investors have advantages during these events that retail investors simply cannot match. They have real-time access to order flow data. They can see where large blocks of stock are being offered. They have direct relationships with market makers who provide insights into supply and demand dynamics. They employ teams of analysts who can rapidly assess whether the selling is rational or overdone, and they have the capital reserves to buy aggressively when they identify opportunities. Retail investors, by contrast, are flying blind with delayed data. limited analytical resources, and emotional decision-making frameworks that evolve for survival on the African savanna rather than optimal asset allocation during financial market stress. This asymmetry of information, resources, and capability is why retail investors consistently underperform during volatile markets and frequently make decisions that benefit institutional players at their own expense. The media narrative that will dominate financial news for the rest of today and potentially into coming days will focus on specific catalysts, whether it's an earnings disappointment, a Federal Reserve comment, or some geopolitical development. These narratives are comforting because they provide simple explanations for complex events, but they're usually incomplete or misleading. Market crashes are almost never caused by single events. They're caused by the accumulation of imbalances, excessive valuations, stretched positioning, and psychological extremes that build over months or years, and then some relatively minor event serves as the trigger that releases all that accumulated pressure. Focusing on the trigger misses the deeper structural forces that made the market vulnerable to a significant correction in the first place, and those structural forces are what determine whether today's decline is a brief interruption or the beginning of something more serious. The options market is flashing signals that sophisticated traders are positioning for continued volatility and potential further downside. Implied volatility levels have spiked, making options more expensive, which indicates that traders are willing to pay higher premiums for downside protection. The skew in options pricing, where puts trade at higher implied volatilities than calls, reflects a fear-driven market where investors are more focused on protecting against further losses than capturing potential upside. These options market signals provide a window into the collective expectations of professional traders who have real money at risk and access to better information than most retail investors. When options markets are screaming fear and a defensive positioning, it's a signal that market participants with significant resources and sophisticated analytical capabilities are concerned about near-term prospects. Portfolio construction principles that worked perfectly during the long bull market are now revealing their vulnerabilities during this acute stress event. Diversification within the equity market provides less protection than most investors assumed because correlations between different stocks and sectors spike toward one during market panics. Everything tends to fall together regardless of fundamental differences, which means your carefully constructed portfolio of diverse technology stocks isn't actually providing meaningful risk reduction when the entire sector is repricing lower simultaneously. True diversification requires exposure to genuinely uncorrelated or negatively correlated assets, which many equity-focused portfolios lack entirely. The psychological toll of watching your portfolio value decline by significant percentages in a single day cannot be understated. It creates stress, anxiety, and a sense of loss of control that affects decision-making ability and general well-being. Many investors will check their accounts obsessively throughout the day, experiencing a fresh wave of emotional pain with each refresh as losses mount. This behavioral pattern is counterproductive because it amplifies the emotional impact without providing any useful information or actionable opportunity. The damage to your net worth happened hours ago based on decisions you made weeks or months ago about portfolio construction and risk exposure. Looking at your account balance repeatedly today doesn't change anything except your stress level. Market bottoms are only identifiable in hindsight, which creates an impossible challenge for investors trying to determine whether today represents a buying opportunity or the early stages of a much deeper decline. Every significant market bottom looks like it could go lower at the time. The fear is palpable, the selling pressure seems relentless, and there's always a compelling narrative explaining why prices should continue falling. Conversely, many days that feel like potential bottoms turn out to be temporary pauses in ongoing declines. Without perfect foresight, investors are forced to make probabilistic decisions with incomplete information under significant emotional pressure, which is why market timing strategies fail so consistently for most investors, despite seeming theoretically possible. The recovery from today's losses, whenever it comes, will likely be swift and concentrated in just a few trading sessions, which means investors who sell today and wait for clearer signals before re-entering will probably miss the best days of the recovery. This is the cruel mathematics of market volatility. The worst days and best days tend to cluster close together, and being out of the market during the best days has a devastating impact on long-term returns. But staying invested during the worst days inflicts real financial and psychological pain. There's no solution to this dilemma that avoids risk entirely. You either accept the volatility and remain invested, potentially suffering through additional severe declines, or you reduce exposure and accept the very high probability of missing the recovery, which historically happens faster than most investors expect. What happens in the next few hours will set the tone for how this event is remembered. If buying emerges, if institutional investors decide that prices have fallen enough to represent value, if some catalyst emerges to restore confidence, today could mark a washout bottom that leads to a sharp recovery. But if the selling continues to accelerate, if no buyers step in, if additional negative catalysts emerge, today could be remembered as the day when a long bull market definitively ended and a new bear market began. The uncertainty is absolute, and the stakes couldn't be higher for anyone with significant wealth allocated to equity markets. You're not just watching numbers on a screen. You're watching the real-time repricing of financial assets that represent claims on future corporate earnings. And when that repricing happens violently, it redistributes wealth on a massive scale from those who are overexposed and unprepared to those who are defensively positioned or have capital available to deploy at depressed prices. So right now, at this critical moment, you need to understand that what's happening to the Nasdaq isn't some abstract Wall Street drama that doesn't affect you personally. If you own stocks, if you have retirement accounts, if you have any exposure to the technology sector either directly or through index funds, you're in the middle of this storm whether you realized it or not. The decisions you make or don't make over the next few days could have implications that echo through your financial life for years to come. This is exactly the kind of market environment where fortunes are made and lost, where long-term outcomes are determined not by what happens to prices, but by how investors respond to what happens to prices. Make sure you're subscribed to this channel because the next few days are going to be absolutely critical, and you need to stay informed about what's really driving these market moves. Not the sanitized narratives you'll get from mainstream financial media that's designed to keep you calm and passive while institutional players make the moves that actually matter. Hit that subscribe button right now, turn on notifications, and stay alert, because the next wave of institutional repositioning could happen at any moment. And when it does, you need to understand what it means for your money before it's too late to respond effectively.